All right, let's talk Synopsys. The company just dropped its pivotal Q4 2025 earnings, and believe me, this is way more than just another quarterly report. It's really our first clean look at a company that's in the middle of a massive strategic reinvention.
And to kick things off, you really got to see this quote from the CEO, Sassine Ghazi. This one line pretty much sets the stage for everything we're about to cover. The main takeaway here is that Synopsys is fundamentally changing its identity, and this is the story of that change.
So let's get right to it, the bottom line. How did this new, redefined company actually perform? This quarter was the first real test, the first chance the market got to see the numbers with that huge Ansys acquisition baked in.
And how did the market react? Well, you could almost hear a collective sigh of relief. The stock shot up 5 to 6% in after-hours trading right after the numbers came out. The chatter from analysts was that the results were better than feared, which tells you there was a whole lot of anxiety heading into this announcement.
Now, when you look at the actual numbers, it's a fascinating split-screen story. On one side, you've got revenue hitting $2.255 billion. That's a massive 37.8% jump from last year. But then you look at the bottom line, the non-GAAP EPS, and while it beat what analysts were expecting, it was actually down almost 15%. So what's going on? The company's getting way bigger, but it's not more profitable per share, at least not yet.
And here's your answer. It's all about Ansys. The acquisition brought in almost $668 million all by itself this quarter. So that massive jump in revenue, it wasn't organic growth from their core business. It was bought. This is exactly what a company in the middle of a strategic remake looks like on paper.
Now, if you're an investor trying to look past the noise, this is the number that really matters. $11.4 billion. That's their record year-end backlog. Think of it like a giant safety net. It gives management incredible visibility into future revenue for years to come, which is absolutely crucial when you're navigating a transformation this complex.
Okay, so those numbers tell us what happened. But the really interesting part, the real story here, is why it's all happening. This is about the strategic remix of the entire company, moving from what they used to be to something much, much bigger.
And this slide really nails the pivot. Think about it this way. The old Synopsys was a master of one very important thing: designing chips. That's their EDA roots. But the new Synopsys, they want to own the whole playground, from the tiniest piece of silicon all the way up to the complete system it powers. It's a much bigger, much more complicated market.
Okay, a huge vision is one thing, but how do you actually pull something like that off? Well, management laid out a very clear three-step game plan. Let's break down exactly what they're doing.
First up, the big one, Ansys. This isn't just about bolting on more revenue. It's about building a brand new pillar for the company focused on simulation and analysis. Second, and this is a tough one, they're restructuring their workforce, cutting about 10% of staff so they can reinvest that money and talent into high-growth areas like AI. And third, and this is a huge deal, they're leaning into a massive partnership with Nvidia, who's putting in $2 billion to co-develop the future of AI-powered design tool.
All right, that's the grand strategy. But what about the here and now? Let's take a look at their flight plan for the upcoming fiscal year, FY26. And the guidance they gave was, frankly, pretty confident.
And the numbers look solid. Revenue guidance is basically right in line with what Wall Street was expecting. No big surprises there. But here's the kicker. Their earnings per share, or EPS guidance, is actually a little better than the street was modeling. That's management sending a clear signal that they believe their plan is working and on track.
But honestly, for a lot of people watching this stock, this is the number that matters most. Management is targeting a 40.5% non-GAAP operating margin. That is a massive expansion. It's the ultimate proof point. It tells investors that yes, they can swallow this giant acquisition and become a more profitable company in the process. That's exactly what the market needed to hear.
But it can't all be sunshine and roses, right? A transformation this big comes with some pretty serious risks. And to their credit, management didn't shy away from talking about the headwinds they're facing. So let's run through the big three risks on the radar. First, there's the geopolitical wildcard, China. Their entire guidance assumes that U.S. export controls don't get any tighter, which is a big if. Second, you have just monumental operational risk. Trying to integrate a $35 billion company while also laying off thousands of people is a recipe for things to go wrong. And third, one of their key business units, Design IP, is hitting a soft patch. They're calling it a transitional year, which could be a real drag on growth.
So let's put all the pieces together. You've got strong numbers, this incredibly ambitious new strategy, but also some very, very real risks. Where does that leave us? What's our call on the stock from here?
After digging through the numbers, the strategy, and all the risks, what's the verdict on Synopsys?
All right, here it is. From our desk, the rating is market perform.
And let me walk you through the thinking here. The bull case is crystal clear and really compelling. You've got a great strategy that's being validated by a partner like Nvidia, a huge backlog giving them a safety net, and a clear path to incredible margins. But the bear case is just as strong, and it all comes down to execution risk. Then you have the swing factors, China and the IP business, that just add a layer of uncertainty in the short term. So our conclusion is this: the long-term vision for Synopsys is absolutely powerful, but the near-term risks are just too big to ignore. We're staying neutral, on the sidelines, until the company proves it can actually pull off this incredibly complex remix.
And as always, just a quick reminder, this is not financial advice.